Okay, sir, we start today's market talk. Expectations based rally need to transform into a fundamentals based rally in 2024. That will only happen when all segments of economy, domestic demand, exports, government spending, private investment will grow. Then it will be a fundamental based rally in 2024 because bulk of returns in 2023 have come on expectations of political stability and interest rates cut by Fed and inflation remaining under control, and shocks on any front will lead to a significant correction. Uh, Market setup as I see it, US yields are expected to fall faster than Indian interest rates, thereby widening the yield spread and attracting foreign investors through risk assets. Risk on sentiment due to anticipation of low interest rates has helped divert the liquidity towards equity, and this is why the asset prices are getting inflated. 7% growth has been led from the front by the government expenditure and urban consumption demand. This is talking about India. Indian economy has been resilient despite RBI's monetary tightening, and after two consecutive quarters of 7.5% plus growth, if this financial year should close with at least 7% growth. That is very nice. To 2024 will bring with it political stability and falling interest rates, thereby pushing private capex. That is what is the expectation. Right now, it is not there. Shocks along any of these fronts could lead to significant corrections. The other issue is China's sluggish economy is expected to keep crude and commodity prices in check. So what is happening is it is China which is exporting deflation across the world because they are selling cheaper stuff all across because there is no demand there, and just to keep their economy going. And this is the reason why the inflation is coming down all over the world, while also improving India's opportunities from a China plus one angle. Geopolitical conflicts are not over. Europe is still struggling, though US is doing well. Basically, despite their aggressive monetary tightening, and China's slump, which is there in the real estate, is likely to continue. It is not going to finish off very quickly. Now, few stocks which are, I think, very attractive. One is Kaynes Technology. Is the first Indian EMS player entering the semiconductor conductor manufacturing supply chain. Is setting up a OSAT facility to bring production, and they will going to begin production in FY25. OSAT is outsourced semiconductor assembly and testing facility. This is the first in India, and in case we become part of the semiconductor supply chain, then they will make good revenues. They are putting an investment of 2,850 crores in Telangana, partnered with Globetronics, which is a global company. The other issue what they are doing is PCB printed circuit boards expansion at manufacturing facility in Mysore for rupees 1396 crore. Guidance is of 1700 to 1800 crore revenues in FY24 with 15% margin. So if you see FY25 expected EPS of around 40-41, presently it is at PE of 63-64. So every dip is a buying opportunity in Kaynes Technology. It's the best among them. It is the best EMS player. The other thing which is good is MapMy India. It operates with a high regulatory moat because new people cannot just come in just like that. So they are the only player in Indian scenario and is one of the few profitable tech companies with high double-digit earning growth. They had a revenue growth of around 28% year on year and EPS growth of 30%. EBITDA margin in Q2 is 45%. 1,000 crore revenue by FY27, 28 is expected. They are making a B2C offering of Map PLS, a rival to Google Map, but it will be difficult to displace Google Map. Their key customers are automotive companies. What is happening is their total addressable market TAM is increasing because of travel commerce, electric mobility, AR, VR, that is augmented reality, drones, etc. It trades at FY25 PE of 60 times, and it has seen around 10% correction, and this is a good level to enter. EPS is around 32, 33. The last one is Fiem. They made a strategic collaboration with Gogoro, which positions it strategically in the evolving EV landscape. Fiem is basically a lighting solution provider for two-wheelers, and increased share of LED lights provide them with long-term opportunity. They are working with all major EV OEMs, and EV sales are 6% of companies' revenue presently. They made an MOU with Gogoro, which is a Taiwanese company, for manufacturing and assembly of EV components such as hub motor assembly, electrical control units, and motor control units. So what is happening is they are diversifying to other parts other than lights. It will provide lighting and mirror solutions for Gogoro's domestic and export markets also. So LED presently contributes to around 47% of sales. With FY25 expected EPS of around 150, 155, this stock is trading at a P of around 14, 15, which is pretty reasonable. Now, seeing certain technical issues, uh, this is US 10-year yield. It is coming down, and now this is a daily chart. So it has come to around 3.8 odd levels, and it is moving up and down. But by February, March, in anticipation of a correction, it should come down. Now it is below its 200 EMA, so it should correct from here. Brent crude, it's again trading below the 200 EMA, and I think it should touch this. It is trending towards the 70 odd levels, which is good for all oil importing countries. Dollar index, now it has come to its 200 EMA. It tested that to around 100 at 100.278. It tested that, and it is likely to go down, and that is good for all metals, because if the US is going to cut rates and rest of the Europe, UK, Japan are not really cutting rates, so then the dollar weakens. Gold, again, I have been bringing out regularly. It is at that 2070 is that peak level. Uh, that is $2070 to the ounce is a peak level, and it is staying there. There is no reason for actually gold to be so expensive, because there is no uncertainty right now. It is only going up because the dollar is weakening. S&P 500 is now nearing its all-time high, and it should break out very quickly from this from these levels next year, as the first signal of rate cuts come in. They have had around 8-9 odd weeks of green candles, and they're trading well above their moving averages. So, and like all global indices, they are doing well. India's 10-year yield is going down, and it is going to go down and maybe test this 100 EMA of 7.1, or there is some narrative from RBI, etc., for a rate cut or something, then it will go below this also, and the rates are going to go down only from here. Nifty weekly chart. So if you see uh, Nifty from the October lows, it has had 8 odd weeks of 7 weeks of green candle, then 1 week was red, and now again it had a solid week based on the year-end rally, or whatever Santa Claus rally we call it. So it is as I was talking about, the present scenario is everyone is watching the clock, but no one quite wants to quit the party right now, because there is a lot of fun right now till the time the party is going on, but everybody is ready to leave. So if you see, Nifty made, this is the daily chart. Nifty made a swing low on October 26, and after that Nifty has made only two swing lows. One was at 20,800 and the other one is at 21,000. Right? So after that, from this low, it has had a continuous uptrend, and so these swing lows will provide the support for the Nifty. It corrects, because generally what happens is, after the rally in short term, the Nifty doesn't correct more than two swing lows. So I don't think it will go down below at least 20,800, 20,800 level, and maybe first support there would be there. This is a daily chart. Otherwise, if you see the 20 EMA is at 21,126. So any dip to these levels will be buying opportunity. And markets are not going to turn bearish in a hurry. But people are always fearful of losing their gains based on all those adverse stories which are floating around in WhatsApp groups, etc., and social media. So, story, what everybody likes to tell is like, they call the top. Okay, I sold at the top, but it's a buy on dip market, and planning on exiting your holding at these time don't seem to be very wise right now. So, as I was discussing before the talk, it seems this bull market of 2023 will continue in 2024, and next correction will offer a very good opportunity to enter. We should make a high of, I think, 22,000 plus in January, and maximum low should be that from the place from where this rally started after that big gap up of around 20,250. That should be that level. Otherwise, these two will provide support. These two swing lows will provide support. So if every subsequent high is higher than the previous one, or the Nifty is making higher lows also, like it has been making now from here, it has been making higher lows and higher highs. So then the every dip would become a buying opportunity. Then the correction will be shallow, and as if you see, the Nifty has a fair value of around 21,000 or 20,000 in the year end. Then if you give it 15% growth, then the for the FY20 for the calendar year 24, then the end target should be around 24 to 23,000 for the Nifty at, if you give it a 15% earning growth. So that should be the thing. Now if you see here in hourly chart, in a very short term, the 40-hour moving average at 21,570 should provide decent support. It will not go down below that. And if you see the retracement of this fall, which it made, it has already gone beyond that. And I was saying this 38.2% retracement level in short term should be the first target. That is 21,827. This should be the first target. It is right now at 23.6% retracement level. So it should go up from here. What is being led, what is leading the Nifty is Reliance. Now it is close to its or double top which it had made this year, and in 22 and 23, and it is likely to go above that. So it is again in an uptrend. So watch for Reliance. The other stock which is doing well is Larsen. It has had a continuous uptrend since June, July last year. And after that, it has nearly doubled from there, from around 1600 levels, 1500, 1600 levels. It has gone to now 3500 odd. So this is one stock to be long on. The other stock, as I was mentioning, is Tata Motors. This is a weekly chart. So if you see, this was the top in 22, and it had a negative year in 22. So, but in 23, this is the 2023. This is the best performing Nifty stock, where it's the only one which has doubled in this financial year, this calendar year, from a level of around 360, 365. It has gone to 780 odd levels, and I think tested 800 also. So these are the ones which are driving. Bank Nifty, if you see on a weekly chart, there is a rising trend line, and it is looking to break that. So if it breaks that, then the first target should be around 50,000 from here. It is above all its moving averages. And if you see the daily chart, it's broken above its all-time high. The the 20 EMA is rising, so it's in an uptrend. And with HDFC Bank being strong, it should head higher. For HDFC Bank, if you see, this area of 1720 to 1750 is always a long-term resistance zone. It has always corrected from there 3 4 times. Hence, watch for this level. It is approaching these levels after its continuous rise from around 1440 odd levels, and now it is heading for that. And right now, this is the one. Even on Friday, when rest of the Nifty Bank Nifty stocks were weak, it was this stock which was strong even on Friday also. So it took the Nifty up, Nifty and Bank Nifty up. ICICI Bank has been weak, and right now it is at around 20 EMA. So for ICICI Bank, I think 1000 is the most critical level. Above 1000, it will be bullish, and below 1000, it should be bearish. So it has to trade above that, and it has to break this rising trend line. It tested that and then reversed from there, and then is now come to its nearest moving average. So let's see what happens from here. PSU Bank Index is seeing a constant rise from 2021 or so, and now it is looking to break. If it breaks or just keeps making higher highs and higher lows, it should keep doing well. It has nearly This one has also nearly become 3 4 times from the lower levels in 2021. So this is one strong sector. Among the PSU banks, the stronger stock is Canara Bank. It has broken through its rising trend line above that. So this was a breakout from here, and then it tested that, and now again it had a positive week. So watch out for this stock for positivity and long term. PSC index, this is a weekly chart. So if you see again, in 22, it has risen from here, and now it has had a vertical rise, and it is reaching that 7,800 odd levels. So this is a level where there is a sector rotation taking place. So because of of the rotation of stocks within the sector in public sector enterprises, this one keeps remaining positive. Among them, because of the power requirement and in future, NTPC is again had a green weekly candle, and it is looking strong. It made a red candle, but then I think the uptrend is again starting somewhere close to 300. It gave a correction, and then again it is starting. But remain invested here. The other stock which had a vertical rise from August September onwards is Coal India. Again, it's a power story, and with better management and better production of coal, this should do well. The index which is doing well or is expected to do well is Nifty IT. So if you see, this is the all-time high, and this was the low it made. Now, if you see this retracement, it has already crossed the 61.8% retracement, and once it crossed this 61.8% retracement, it is now headed for 78.6, but it will eventually test the uh, all-time high it made, and I think this should take place moment the if the IT earnings oblique guidance is positive, so that will give a fillip to this. Right now, it is consolidating, but falling interest rates in the US and strong GDP growth is always favors the IT stocks. One of the IT stocks which is doing well is LTIM, and again, it has had a positive thing, and now it is on weekly charts. It is trading well above the 2050 EMAs, and it is heading higher. So these are the stronger stocks one should keep in mind, and it may test this all-time high. It made around 7,600 in 22, so that is highly possible. In mid-cap IT, the one stock which is strong is Cyient, uh, which had a major breakthrough after in 2023 because of better guidance and better growth. And this is the stock which has gone to around 2,400. So it is now resting there and corrected last week. But I think every correction here is a buying opportunity. The midcap index continues to do well. This is a weekly chart of Nifty midcap index. It tested the 20 EMA in October and then bounced back from there. And in every correction here in the good quality midcap stocks, they will give sharp corrections as it happened last week. But that should be a big buying opportunity. One of the stocks which is doing well is Apar. If you see here, it tested its double tops and it is now breaking out from its double tops. And if you remember in this group, I recommended it here at somewhere around these levels, 3,500 odd levels in July, August. I had recommended this, and now it has moved up very sharply from there and it's consolidated. This is time consolidation, and again it is going up from there. If it breaks out from there, then we'll head for higher targets again. The other stock which is doing well is Bharat Forge. This is basically a defense story now, more than forging story. It has broken above the its all-time high, and now it is heading higher. So watch out for this stock. Uh, this was the old high around 1150, but it is now well clear of that. So there is a lot of momentum here, and you see the volumes have been high out here. The small cap index is also similarly like mid cap index is doing well and had a green week, and it is above the 20 EMA on a weekly chart also. So every in case there is a big correction, then that becomes a buying opportunity. Among the stocks here in the real estate, Macrotech developers. So if you see here, it has broken out from its top. It made a dip, tested the 20 EMA, but it has broken out and now it is headed higher. And last week was very good, and I think there are some record bookings in uh, Mumbai, etc. Hence, this is reflecting that, and now it has reached that thousand odd levels, which should be very positive for the this stock. And if you see, it broke out with large volumes, so just keep a watch here. Sale, it made a rounding bottom, and then it has broken out from there, and it is headed higher. So if you see here, it is now well clear of all its moving averages on the daily chart, and it took support at the this trend line which is there, the last top, and now and then it has gone above that. So now this is looking positive, and every it's direct correlation to dollar index. So if the dollar index corrects, then the metal stocks do well. Talking about Tata Technology, somebody had asked for that. So now let's see the relative valuations of Tata Technology. It came at, just to recapitulate, it's a ER&D company. They came they came up with an IPO with a market cap of around 20,000 odd crores, and now it is at 47,000 crores. So, and they sold 2-3 months back a stake to TPG at rupees 401. Right now it is at 1180. And so if you see now, the PE is as comparable or slightly higher than Tata Elxsi. So it is now making Elxsi look good. And now competing with KPIT, if you see the operating margins, Tata Elxsi has better operating margins, so they will always have higher EPS as compared to that. And ROEs again are similar to Persistent and KPIT. Quarterly sales growth, this is guiding around 15-20%, while KPIT has guided for around 60%. So that's why PEG ratio, PE to growth ratio for Persistent and Elxsi is 2 plus. But for KPIT, because of high growth, it is only zero point 0.2. So keep a watch on this. Uh, I feel that it should correct. Also, KPIT has higher margins and higher guidance. It has corrected also. KPIT has a deal with Renault, Infosys with Dalmar, Persistent with Dassault, Cyient with Pratt& and Whitney, and Tata Tech has deals with Airbus, Honda, and Tata Motors and JLR, of course. So there is no need to really go after this stock. I think if you watch this stock, the buying came at 1150, so that should be the one level to buy and wait for results and guidance. They gave a revenue growth around 15-20%, which is normal as per the industry. So there is nothing great about this. Now talking about one of the IPOs which came recently, Azad Engineering. It is one of the preferred manufacturers of complex and highly engineered precision forged and machined components for OEMs in energy. 89% of the sale as of first half of FY24, aerospace and defense, and oil and gas industries. It has delivered 3.09 million units of 3D rotating airfoil blade portions of turbine engines and other critical components over FY29 to 23. That is roughly around 15 years of experience, including some with 0 parts per million defects requirement. This is 0 parts per million is much even better than Six Sigma, which is actually 3.4 defects per million. So uh, this is high quality precision engineering. It derived 90% of its first half revenue from exports to global OEMs backed by long term contracts. Key customers are General Electric, Honeywell International, Mitsubishi Heavy Industries, Siemens, Eaton Aerospace, and Man Energy Solutions. Azad Engineering delivered robust growth with revenue PAT CAGR of 43 and 33% over FY 21-23. It enjoys high margins, which improved to 33% in first half from 22 or 23% in FY 21. Its ROE post dilution is healthy at 15% for first half, and ROE has come down because of they have issued more equity, so it will come back to 18 to 20% subsequently. And post repayment of debt of the existing debt, net debt to equity will get reduced to 0.1 times. It will benefit from industry tailwinds, especially in aerospace and defense space, which could improve its revenue mix. It has presence in high growth niche segments with high entry barriers. So it is not that easy for somebody to get into these kind of businesses which are supplying to niche clients. Uh, it requires very stringent qualification process which takes up to 30 to 48 months for onboarding a new vendor with these companies which are manufacturing precision tools and parts. Now, if you see their FY24, if you see their results, the revenue growth is around 29 to 26% is there in FY24. So if you see FY21 and FY23, the revenue has nearly doubled, and the PAT is also going up. EPS went down in FY23 because they were, I think, putting some capex. ROE is now improving. P's will come down. So if you see uh, EPS of 9 to 10 at 65 to 70 times, and they should be reasonably valued because they have EBITDA margins at 33% and PAT margins at 18.5% for H1 FY24. Uh, so that is one aspect. Now, they are supplying to highly regulated industries, aerospace and defense, with total addressable market is 1530 billion. That is 1 billion is 100 crores. So that is roughly 1.5 lakh crores. Then energy is again around 28,000 crores, and oil and gas is roughly 73,000 crores. That's the total addressable market. Uh, for energy, they supply components to five key manufacturers in turbine manufacturing industries. Uh, which control 70% of the gas turbines globally. Siemens, GE, MAN, Honeywell, Mitsubishi, etc. Uh, to global manufacturers, they are supplying components for drilling equipment manufacturing industries. Uh, Again, six of the key manufacturers in aerospace and defense industries and supplier to major commercial aircraft manufacturers. They are well diversified across geographies. So it is not concentrated to one part or one part of the world and all that. And their income from private sector is much more than what they are getting from government. So uh, they are not that much dependent on government orders, and so they have a cash flow issue. So exports are forming 80 to 90% of the revenue. So if you see this, steady revenue growth is visible. Strong EBITDA margins, they're reaching around 33% now, and PAT is growing at 33% over FY21 to 23. uh, Sorry. Uh, okay, they are they have four manufacturing facilities in Hyderabad, and they are operating at 90% utilization, and they are developing two additional plants, including a dedicated unit for Mitsubishi. Uh, so if you see revenue, CAGR, etc., uh, it is uh, it is in a high quality business and a stock to be bought on all depths. Next one is Inox Wind. Now, this to understand this stock, first one has to understand the also understand the what is happening with wind energy in our country. Uh, Okay. Uh, in Inox Wind, a grid with strong array of renewables need more wind in the mix given its competitiveness and complementarity to solar. So what is happening is you cannot have only reliance on solar energy because uh, the off solar times, then the wind energy is able to supply the power, and the storage cost is five or six times the cost of setting up wind energy. So what is happening is now hybrid plants are being made where there are both solar and wind component are included, and that is what the contracts are taking place. Now there are basically two players, Inox and Suzlon, in the market who engage in supply, installation, and maintenance of turbines. Now, this is very important because other players only give supply and provide component, but they are not into maintenance of turbines, etc. And people are looking for full stack suppliers, especially the public sector entities who want people to maintain them also subsequently. Uh, Public sector entities will play a larger role in the upcoming renewable grids. Government has also set monthly and quarterly targets for renewable capacity auctions for FY24 by all the big PSUs, NTPC, SECI, this is the Solar Energy Corporation of India, NHPC and SJVN. Wind sector endured a downturn due to policy discontinuity that saw emergence of reverse auction to procure wind power in FY17. I'll cover what is a reverse auction. Low prices discovered in these auctions and higher prices compared to solar. So there was lack of interest, and then people were not putting up those projects. Hence, what happened was that all the companies were supplying wind energy. They went into losses and then they moved out. India is looking to add 8 gigawatt per annum of wind until FY30. Wind market shall improve from 2 gigawatt in FY23 to 3.5 gigawatt in FY24, 4.5 gigawatt in FY25, and 6.5 gigawatt in FY26. So if you are looking at uh, 10 gigawatt, 8 to 10 gigawatt per annum of wind capacity till FY30. So you see, if there are only two large players and maybe a third player also comes in, they are likely to execute around 3 gigawatt of projects per annum. And presently, they are not even executing 500 megawatts. Current order book is 1.5 gigawatt. Estimated 500, sorry, it is megawatt, it's not gigawatt. 500 megawatt execution in FY24 and 850 megawatt execution in FY26 is expected. Uh, what they have done is they have significantly paid their debt on its balance sheet as of H1 FY24 with the capital infusion worth 1840 crore from promoters through basically preferential shares, issue of warrants, and sale of their one of their subsidiaries. Thus, after the recent capital infusion and sale of wind assets of 290 crore, interest bearing debt as of FY24 is only 434 crore. It was uh, around 2700 crore earlier. Up until FY17, India was following a feed-in tariff mechanism for setting up of wind generation capacity. Under the feed-in tariff mechanism, DISCOMs entered into long-term uh, projects and partnerships with a determined tariff for generation from wind capacity. So it was pre-decided. The feed-in tariffs were decided by state regulators based on expected normative cost. Along with this, several other incentives like accelerated depreciation, generation-based incentive, etc., were provided for setting up wind capacities. Now, what happens with accelerated depreciation is that in case in the first few years you are able to depreciate your assets, then your tax outgo reduces. So that was one of the major incentives that was stopped. India moved away from feed-in tariff mechanism and new capacity addition opportunities reduced as tariffs dropped sharply under the bid-based mechanism, and investors only flocked to high wind state to set up wind capacities. Even there also, there was a problem because of acquisition of land. Uh, so the wind capacity addition in FY21 was only 1.5 gigawatt as compared to 5.5 gigawatt in FY17. So now the government has come up with new bidding mechanism, which will be based on single stage two envelope basis. So there would be one technical bid and one financial bid. Both will have to be given together, and then based on that, the projects will be awarded. So this is the basic change which has happened. Now, if you see their history, their revenues were good, uh, roughly around 4,500 odd crores uh, by FY16. And once the policy change took place and government did away with feed-in tariff mechanism and bid-based capacity addition resulted in decline in wind capacity addition. So if you see from FY17, 18, 19, decline, and now it is again coming up after the new government policy initiative have brought some life back in this sector. So if you see here, the order executions decreased and revenues decreased, and order executions reached 100 megawatt only in FY23, and now it is likely to go up from here. So now, if you see India's renewable energy capacity has reached 125 gigawatt as of FY23, and share of solar and wind is at 53% and 34% respectively. But if you see, when it started, the in FY10, the share of wind was much higher. It has gone down to from 70% to 34% now, and solar has gone up to 53%. Others are at below 10% right now. The small hydro and others and all that. So this is the basic issue, but this has gone to 125 gigawatts already now, and it is expected to go up further. What Inox Wind did was they had a debt of around 2715 crores as of H1, and they had certain cash and all. So net debt was around 2400 odd crores. So they sold one of their stakes, got 1000 crores from there. Then promoters infused some cash by selling stake in Inox Green. Then anytime promoters put cash in the company, it is always positive. Then promoters put in some equity into the company through preferential shares that were 460 crores. So the net debt again reduced to 1234 crores. Then again, the promoters put more equity of 800 crores. So the net debt is come down to around 434 crores now. So it has come less. So it will obviously improve their profits now. Now what they are doing is they are setting up 3 megawatt turbines. Well, earlier they were having 2/2.6 megawatt turbines, and some of the older turbines are below 2 megawatts also. So now what happens with these similar wind speed and similar space requirement, they are able to produce higher amount of output power, that is through the 3 megawatt turbine. Now their earnings. So if you see, their earnings is roughly 5.5 or 5.6 CR per megawatt. So if they are able to do around 1 gigawatt in next 1 or 2 3 years, so that means they will make roughly around 6,000 odd crores from revenues from as per this only. So that's why the earnings and revenues are expected to improve from here, and that is what is reflected here in terms of execution. Now, how their business is divided, they have a manufacturing, that is Inox Wind. They manufacture these turbines, blades, and towers, etc. And they are planning to increase their capacity to 2 gigawatt hour with commissioning of 3.3 megawatt WTG. Then operation and maintenance is under the subsidiary called Inox Green. So they get all the operation and maintenance contracts for all project sites of Inox Wind, and also contracts with third party suppliers and spares, in-house manufacturing inventory, and maintenance at sites oblique warehouses. In addition, there are some 9 gigawatts of past wind facilities which are in state of disuse, or now they are not been maintained. So that is additional opportunity for Inox Green. For EPC, they have this another subsidiary called Resco Global Wind Services. They provide end-to-end services leading up to installation of turbines, constructing substations for power evacuation, high grid availability, and minimum power losses. So it's a full stack business. So this is what the new customers or the PSUs prefer. Now, talking about their financials, so if you see in FY26, they are likely to do, this is in millions, roughly 5,400 crores of net revenue. Estimates will vary. EBITDA margins are expected to be around 15%. So net profit, as I worked out, as per the thing, is going to be 650 crores, because it's so easy to calculate. They are making around 5.6 to 6 crores per megawatt. So you can easily calculate this. So they are likely to have a EPS of around 1920, and if you give it a PE of around 25 to 30, then it can easily trade in future at 500 to 600, where it is already reaching actually now. It is getting discounted very quickly now, and ROC and ROE are expected to improve. Uh, these are the technical charts. So if you see, this is where some the promoters had put in equity into the business. So if you see from here, which was roughly 210 odd levels, where I recommended to get into this stock, it has shot up to 500 odd. This is what 500 it touched on Friday, and it's a constant rise because people are discounting the future earnings. And if you see here, volumes have increased drastically here. So this is a stock to be kept on radar and bought on all grid. Now, what is going to happen with this is a lot of PSU tenders will come on stream in Q4 of FY24. So the additional bidding pipeline would be around 1.5 gigawatts. We have seen the estimate. PSUs look for people who can supply turbines as well as undertake EPC and operation and maintenance. It has high success rates in NTPC tenders, and also a lot of companies are creating captive renewable energy resources. So that is again seeing huge traction in Rajasthan and Gujarat. RE mix to meet the complex power demand uh, has improved the outlook, because in the when the sun is not there in the night time, you have to create you have to still supply power, so the hybrid projects are being created. I spoke about accelerated depreciation. It allows asset owners to write off more of value of assets during initial years of ownership, thereby reducing its taxable income. And what the problem with reverse e-auction, which the government introduced in 2017, was that participants have an option to match their bids with lowest bid to reduce the bid even further. This led to sharp reduction in discovered prices in wind auctions. So the results were seen in all wind energy players, including Suzlon and all. Their debts got up and their revenues, uh, finished off, and hence they were in a bad state. So now they are recovering. Uh, Coal is accounting for around 96% of carbon emission from power sector, and India needs to reduce its dependence on coal to meet its target of 45% reduction in carbon emission by 2030. So, what now the government is doing, they are doing renewable purchase obligations for entire country, and based on this, the target is to source 7% of power consumption from wind energy by 2030. And there is going to be also replacement of all old turbines also, which are there in the present capacity under 2 megawatt, because some of them are not actually functioning. Now, in Inox Green, which is its subsidiary, it signs long-term contracts for operation and maintenance. Uh, so for at H1 at FY24, they have around 3,200 megawatt of operation and maintenance contract. And as I blocked out, 9.7 gigawatt hours of projects are with inactive players. So that is another opportunity for Inox Green. The last stock I'll cover today is Happy Forgings. Again, it listed recently. It's a leading Indian forging and machining company incorporated in July 1979. It specializes in designing and manufacturing heavy forgings and high precision machine components, offering a wide range of solutions in the heavy commercial vehicles, farm equipment, off-highway construction, and industrial equipment and machinery for oil and gas, power generation, railways, and wind turbine industries. So it is basically two parts, forging and machining. And you will see that machining has got higher margins as compared to forging. So these people are getting more into machining now. It has a strong competitive edge by concentrating on margin accretive value added products. The contribution of machine products has risen from 73 odd percent in FY21 to around 84% in first half of FY24. The focus on machining and value addition has resulted in this company achieving highest EBITDA margins among its peers. So highest EBITDA will lead to highest profits. 45% of its revenues are from crankshafts, and balance 55% comes from front axle beam, steering knuckle, differential case, brake flange, suspension bracket, planetary carriers, pinion shaft, housing bush, connecting rods, camshafts, piston bin, valve body shafts, crown wheels, and ring gears. Now, if you see, Happy Forgings is a this is a Punjab-based facility. They have plants in basically Ludhiana, and they this is their forging capacity at their two plants in Kanganwal, 1 and 2, Dugri. So total is and this is the average available capacity and the utilization in first half FY23, FY22, and FY21. And they have machining again at Kanganwal, Dugri. Total is given here, and the utilization is pretty high for machining and all that. They are supplied to all top OEMs in CV industry and farm equipment industry. Now, the CV industry is a direct correlation to the uh, growth in the economy and all that. So they have highest EBITDA and PAT margins among peers, and all manufacturing facilities, as I brought out, are in Ludhiana. Uh, this is their profit and loss account. So if you see, revenues have doubled over 2 years. So it has reached, this is in millions. So it has reached around 1200 odd crores in FY23. And if you see the EBITDA, they are all positive. Uh, so the PAT is around 208 crores and EPS of around 23 odd in FY23. So now if you see their relation to their peers, this is Happy Forging, this is Bharat Forge, Craftsman Automation, and Ramakrishna Forging. So if you see here, the PAT margins 17% here, and rest are around single digits. Return of equity also is higher among in them, around 21%. And return on capital employed also. Uh, Total capacity there is less, but it's okay. Uh, EPS is there, and PE. If you see at the PE at which they came, they were around 40 times, and rest were 45 to around 50 times. So that's what I said, around 1,000. This should be a easy stock to get into. Uh, Now, what happens is what they are basically doing is making crankshafts which converts linear to rotational motion in combustion engines. OEMs nowadays are preferring lighter forged designs for efficiency and reliability. Globally, market is expected to reach around $47 billion for led by basically for by automotive industry. And uh, the reason is basically it is being this is only for forging. This is driven by investment in construction sector, and basically in South Asia, where the construction sector, there is a boom right now, and it is likely to continue for next 4 5 years. And machining globally is a 53 billion industry where people are looking for very very sophisticated parts. So this is the basics about the business. And again, so this stock again is a buy at the present price. So I finished. We'll take questions now.